Welcome to another broadcast with Latest Synth. Yo, thank you for joining. I really appreciate it. It's another day. It's 12:29 p.m. Pacific time. It's March 9th, 2026. Let's get to it. Oil is already near a price that hurts the economy. President Trump's preferred oil price may be around $50 a barrel, but the war with Iran is getting him prices associated with recessions. Brent crude approached $120 late Sunday, slipping back to around $100 Monday morning. There is no exact number at which governments and consumers react to costlier oil. Between $110 and $120 a barrel is where demand for crude starts to erode, according to energy analysts. Though not cataclysmic, sustained prices at these levels will do damage. The pace of increase also matters. Sudden shocks can trigger a more negative response from consumers than a gradual increase. We started the year at $60 oil, going to $90 or $100 in a very short period of time has a stronger psychological impact at the pump, said Jim Burkhard, head of crude oil market research at S&P Global Energy. Globally, the risk of a stock market correction increases when the oil price jumps at least 50%, and these levels are sustained over a number of months, according to Deutsche Bank analysis. A hawkish reaction from central banks is another risk factor, and if an economy is already slowing an oil price, shock can tip it into a downturn, as happened after the 1990 Gulf War. True, the global economy needs around half as much crude as it did a few decades ago to generate thousands of dollars of economy activity. Cars are more efficient, alternative fuels are available, and economies have shifted towards services which aren't as energy intensive as manufacturing. But the US economy is still more reliant on oil than others. US oil intensity is twice as high as the European Union and 40% higher than China's, according to Rosemary Kalinick, director of the Middle East program at think tank Defense Priorities. This is largely because the US doesn't have much public transportation or EV adoption. That makes it harder for American consumers to shield themselves from rising gasoline prices. Prices at the pump are likely to go higher in the coming days, on top of their 50-cent climb since a week ago. According to GasBuddy energy analyst Patrick DeHaan, Americans are already spending $187 million more a day on gasoline than they were a week ago. There is an 80% chance that gasoline hits $4 a gallon this month. DeHaan estimates the flip side of high prices is that the export revenue of major oil producing economies whose suppliers aren't trapped behind the Strait of Hormuz will get a boost. This includes the US, Canada, and Brazil, among others. Russia is also getting a welcome breather after fresh US sanctions hits its oil revenue. America's oil production has ballooned, so the economic lift from rising energy prices will be sizable. Since 2010, US liquids production has increased by more than Saudi Arabia's entire output. However, the sector's windfall may not be enough to offset the drag on other parts of the economy. Despite Europe's lower oil intensity, its status as a big energy importer makes it vulnerable. The continent is now facing its second major energy shock in 4 years. Governments in Asia are already moving to shield their consumers from inflation. China and Thailand have been banned exports of refined oil products. But this will have a ripple effect on global prices for gasoline and diesel. Gains in wholesale diesel prices already outstrip moves in Brent crude. Truckers, farmers, and airlines may bear the brunt of the impact first. The disruption in the Strait of Hormuz is having a disproportionate impact on the prices of diesel and jet fuel. Because the Middle East is an important source of those fuels, said energy economist Philip Verliger, US shale deals a lot of gasoline, but not as much diesel and jet fuel. Oil from Venezuela does produce a good amount of diesel, but it won't be enough to offset the loss from the Middle East. United Airlines chief executive Scott Kirby said rising fuel costs, airlines' second biggest expense after labor, will be passed on to passengers quickly. History shows that energy price shocks can already hurt automakers. The auto industry experienced plunging sales during the oil prices shocks of both 2008 and 1990. The last time oil prices went above $100, the global economy weathered the shock. Brent crude futures reached a peak of about $128 a barrel in 2022, which equates to more than $140 a barrel in today's dollars. In 2008, crude oil hit a high of around $145 a barrel, which in today's dollars would equate to about $215 a barrel. Beyond a certain threshold, high prices can undermine themselves by causing demand destruction. Vergler notes that the U.S. in 2022 had some cushion from stimulus checks as well as lower interest rates. Today's economy is more K-shaped, and that could exacerbate the slowdown for the average American, he said. On Sunday, U.S. Energy Secretary Chris Wright told Fox that the surge in energy prices is temporary. Oil traders look increasingly skeptical. The oil futures curve is starting to price in a longer disruption to supply than it was this time last week. In just a week, the oil price has reached risky territory. The biggest question now is whether it stays there long enough to cause real damage. Again, thank you for joining. I really appreciate it. Smash that like button, subscribe to the channel, comment down below, let me know what you think. Follow me on Instagram, the Studio 11. Follow me on X, the Studio 2020. I like to say Twitter, follow me on Twitter. Thank you for joining. And of course, I'll see you on the next one.